Let me tell you about something that's happening right now in December 2025 that represents one of the most serious challenges to American financial power in decades. Russia has found and is actively exploiting a fundamental vulnerability in the system that has protected American economic dominance since the end of World War II. And the implications of what's unfolding could reshape global finance in ways that weaken the United States for years to come. This isn't about military confrontation. This is about financial architecture, economic leverage, and the slow motion collapse of mechanisms that have allowed America to wield unprecedented power through control of global finance. Russia has triggered what I'm calling the pressure point, the place where American financial dominance is most vulnerable to coordinated attack. Let me walk you through what's actually happening, because this is complex and the mainstream media isn't explaining it clearly. The foundation of American financial power rests on several interconnected pillars. The dollar as the world's primary reserve currency, the SWIFT messaging system that banks use for international transfers, the centrality of U.S. financial institutions in global capital flows, the dependence of international trade on dollar clearing. Together, these create what I call America's financial shield, the ability to use economic tools to advance national interests without suffering comparable costs ourselves. We've used this shield aggressively. We sanction countries by cutting them off from dollar markets. We freeze assets held in U.S. financial institutions. We pressure international banks to comply with American policy or face penalties. We print money that the world must accept because they need dollars for trade and reserves. It's been extraordinarily effective for decades. But every shield has weak points, and Russia, after being hit with the most comprehensive sanctions ever imposed on a major economy following the Ukraine invasion in 2022, has spent the past 3 years probing for those weak points. By December 2025, they've found them, and they're pushing hard. The first pressure point is the dollar's role in energy markets. For 50 years, oil has been priced primarily in dollars. This created automatic, permanent demand for U.S. currency. Every country that needed energy, which is every country, needed dollars first. Russia is systematically dismantling this arrangement. Russian oil and gas now trade almost entirely in non-dollar currencies. Sales to China, which takes roughly 2 million barrels per day of Russian oil, are settled in yuan and rubles. Sales to India, over 1.5 million barrels per day, use rupees and dirhams through complex currency arrangements. Russia sells gas to Turkey in rubles and lira. Even some European countries, despite sanctions, are finding ways to pay for Russian energy in euros or through intermediaries because they need the energy and Russia won't accept dollars. Each of these transactions represents energy trade exiting the dollar system. When you add up Russian energy exports, roughly 7 to 8 million barrels per day of oil plus substantial natural gas, we're talking about well over $200 billion annually in energy transactions that used to require dollars and now don't. That's direct destruction of dollar demand from one of the world's largest energy exporters. But Russia isn't acting alone, and this is what makes it a systemic threat rather than just one country's policy. Russia has coordinated with other major energy producers to follow the same model. Iran sells oil to China in yuan, another 1.5 million barrels per day outside the dollar system. Venezuela does the same. Russia and Saudi Arabia, despite differences on many issues, have found common ground in supporting oil prices and accepting alternative currencies. The cumulative effect is that the petrodollar, the system that made dollars indispensable for energy transactions, is dying. By December 2025, an estimated 20-25% of global oil trade settles in currencies other than dollars. 5 years ago, that figure was under 5%. The trend is accelerating, and Russia is actively promoting this acceleration through its diplomatic and economic engagement with energy producers and consumers worldwide. The second pressure point is SWIFT and international banking infrastructure. After Russia was expelled from SWIFT in 2022, Western policymakers assumed this would cripple Russian international trade. It didn't. Russia activated alternatives that have now matured into fully functional parallel systems. Russia's SPFS, System for Transfer of Financial Messages, now connects over 560 financial institutions across more than 20 countries. It processes millions of transactions monthly. More importantly, it's interconnected with China's CIPS, Cross-Border Interbank Payment System, creating a combined alternative to SWIFT that covers huge portions of Asia, the Middle East, and increasingly Africa and Latin America. These systems work. They process payments, they clear transactions, they settle trade. Russian companies can conduct international business without touching SWIFT or dollar-based banking systems, and other countries are joining not because Russia forces them to, but because having an alternative to Western-controlled financial infrastructure provides insurance against sanctions, leverage in negotiations, and independence from American oversight. By December 2025, approximately 30% of Russia's international trade is processed through these alternative systems. That's up from essentially 0 3 years ago. The systems are becoming more sophisticated, more reliable, and more attractive to countries that want options beyond Western financial infrastructure. The third pressure point is currency reserves. For decades, countries held the majority of their foreign reserves in dollars, primarily in the form of U.S. Treasury bonds. This created steady demand for American government debt, allowing the U.S. to borrow at lower interest rates than would otherwise be possible. Russia's actions are undermining this system. Russia itself liquidated most of its dollar reserves before they could be frozen, selling treasuries, converting dollars to other currencies, gold, and physical assets. But more importantly, Russia is actively encouraging other countries to diversify away from dollar reserves by demonstrating that dollar assets can be frozen or confiscated at any moment for political reasons. The message Russia spreads through diplomatic channels, through media, through economic forums is simple. If you hold your wealth in dollars in U.S. financial institutions, you don't really own it. You own it conditional on Washington's approval of your policies. If the U.S. decides you're an adversary, your reserves can be frozen overnight. Better to diversify into assets Washington can't touch: gold, real estate, yuan, euros, commodities. This message is resonating. Global dollar reserves have fallen from 72% of total reserves in 2000 to approximately 58% by late 2025. The decline has accelerated in recent years. Central banks are buying record amounts of gold, over 1,000 tons annually in 2023 and 2024, the highest levels in decades. They're repatriating gold from vaults in New York and London to their own capitals. They're increasing holdings of yuan, euros, and other currencies. Each percentage point decline in dollar reserves represents reduced demand for dollars and treasuries. With U.S. government debt now exceeding $36 trillion and deficits continuing at over $1.5 trillion annually, we depend on foreign buyers to finance government spending. As those buyers diversify away from dollars, interest rates must rise to attract purchasers, increasing the cost of servicing existing debt and funding new deficits. The fourth pressure point is commodities pricing. Oil isn't the only commodity that traditionally priced in dollars. Metals, agricultural products, natural gas, most internationally traded commodities have used dollar pricing. Russia is working to change this across the board. Russia is one of the world's largest exporters of wheat, fertilizer, aluminum, nickel, palladium, and numerous other commodities. Russian policy now encourages or requires payment in rubles or acceptable alternative currencies for these exports. Since Russia supplies significant percentages of global markets in several key commodities, buyers must either acquire rubles and other currencies or stop buying from Russia. Many countries, particularly in Asia, Africa, and the Middle East, are choosing to acquire alternative currencies rather than forego Russian commodities. This creates additional demand for non-dollar currencies and reduces dollars' role in commodity markets beyond just energy. The fifth pressure point, and perhaps most concerning, is demonstrating that sanctions can be survived and even used to strategic advantage. Western policymakers relied on the belief that comprehensive sanctions would force behavioral changes through economic pain. Russia has proved that with sufficient preparation, alternative partnerships, and economic resilience, even the most severe sanctions can be weathered. Russian GDP contracted in 2022 but returned to growth in 2023 and 2024. The economy adapted, redirecting trade from Europe to Asia, substituting imports, increasing domestic production of previously imported goods, integrating with China's economy deeply enough that Chinese demand and supply absorbed what European markets rejected. The ruble stabilized after initial volatility. Living standards declined, but not enough to threaten regime stability. By December 2025, Russia is demonstrating to the world that American financial power, while significant, is not omnipotent. Countries can be cut off from dollar markets and survive. Assets can be frozen and economies can adapt. Alternatives exist and function. This demonstration effect is Russia's most significant contribution to breaking America's financial shield. Every country watching, Iran, North Korea, potentially China if tensions over Taiwan escalate, learns that American financial weapons have limits. This reduces deterrence value of sanctions threats and encourages countries to take actions they might otherwise avoid out of fear of financial punishment. Now, let me explain why this is happening now and why American policymakers are increasingly alarmed. Several factors have converged to make America's financial vulnerabilities more acute in late 2025. First, the sheer scale of U.S. government debt creates fragility. At $36 trillion, with annual interest payments exceeding $1 trillion, the U.S. is more dependent than ever on foreign buyers of Treasury bonds. Any significant reduction in foreign demand translates directly into higher interest rates and increased debt service costs, creating a vicious cycle. Second, the weaponization of the dollar has been so aggressive and comprehensive that it's triggered defensive reactions globally. It's not just adversaries building alternatives. Even allies are uncomfortable with the level of financial control Washington exercises. European countries have discussed creating payment systems independent of SWIFT. Even traditional U.S. partners want insurance against potential American financial pressure. Third, China's role as alternative anchor for non-dollar systems has matured. The yuan internationalization that seemed theoretical 5 years ago is now operational reality. CIPS processes over $15 trillion annually. UN clearinghouses exist across Asia, the Middle East, and Europe. Chinese banks can facilitate international trade without routing through New York. This provides viable infrastructure for countries wanting to reduce dollar dependence. Fourth, digital currencies and cryptocurrencies create new mechanisms for avoiding dollar-based systems. While most cryptocurrencies remain volatile and unsuitable for major trade, the technology demonstrates that value can be transferred internationally without traditional banking systems. Russia has explored cryptocurrency for sanctions evasion. Some countries are developing central bank digital currencies explicitly to reduce dependence on dollar clearing. Fifth, U.S. domestic dysfunction reduces confidence in American financial stability. Political gridlock, debt ceiling crises, threats of government shutdown, and polarization create uncertainty about American economic management. When the world's reserve currency is managed by a government that can barely pass budgets or avoid default threats, confidence erodes. The immediate effects of these pressure points being triggered are already visible in December 2025. Treasury yields have risen despite Federal Reserve efforts to manage rates. The 10-year Treasury note is trading above 4.5%, reflecting reduced foreign demand and risk premiums. This increases federal government borrowing costs significantly. The dollar has depreciated roughly 8–10% on a trade-weighted basis over the past year. This makes imports more expensive, contributing to inflation pressure. It also makes American assets cheaper for foreign buyers, which provides some offset, but the net effect is reduced purchasing power for Americans. Corporate America faces increased costs for international operations. Companies that assumed dollar dominance and structured global operations accordingly now deal with currency risk, the need to maintain multiple currency balances, and the complexity of operating across incompatible financial systems. Financial services firms, banks, investment companies, insurance that have been central nodes in dollar-based global finance face disintermediation as more transactions bypass U.S. financial institutions. This represents lost fees, reduced influence, and strategic disadvantage. Now, let me tell you what options the United States has to address these vulnerabilities, because the situation isn't hopeless, but the options are limited and none are easy. First, fiscal discipline to reduce debt and deficits. If the U.S. could credibly commit to reducing the debt to GDP ratio over time through spending restraint and revenue increases, confidence in American financial stability would improve. But political polarization makes this essentially impossible. Neither party is willing to make the hard choices, cutting spending on priorities their base supports or raising taxes required for fiscal sustainability. Second, maintaining technological and financial innovation leadership. If American financial technology, digital payment systems, and fintech capabilities remain superior to alternatives, there's incentive for countries to continue using dollar-based systems despite political concerns. This requires investment in financial infrastructure, regulatory frameworks that encourage innovation while maintaining stability, and ensuring American financial services remain globally competitive. Third, strengthening alliances and multilateral institutions. If the U.S. can embed dollar-based systems within multilateral frameworks that give other countries voice and ownership, they're more likely to maintain these systems despite American leadership. This requires genuine power sharing and accepting constraints on unilateral American action, things U.S. policymakers are historically reluctant to do. Fourth, offering positive incentives rather than just sanctions threats. The U.S. has relied heavily on punishment, sanctions, asset freezes, financial exclusion as policy tools. Developing more positive inducements, financing for development, technology transfer, market access, investment, could provide alternatives to China's Belt and Road model and maintain influence without triggering defensive reactions. Fifth, strategic accommodation on some issues to preserve financial architecture on others. Not every foreign policy goal is worth risking the dollar's reserve status. Some prioritization and acceptance that we can't have everything we want might preserve financial power for truly vital interests. This requires strategic discipline that Washington often lacks. Sixth, preparing for a multipolar currency world, rather than trying to maintain exclusive dollar dominance, except that the future likely includes yuan, euros, and potentially other currencies as significant international mediums. Focus on ensuring dollars remain important even if not dominant, and structure American economic strategy accordingly. The hard reality that policymakers face in December 2025 is that Russia has successfully demonstrated that America's financial shield has cracks. The system that protected and projected American power for 75 years is under stress from multiple directions simultaneously. Russia triggered the pressure point deliberately and strategically. They didn't attack the strongest parts of American financial power. They probed until they found vulnerabilities, then exploited them systematically while building coalitions with other countries that share interest in reducing American financial dominance. The dollar won't collapse tomorrow. U.S. financial institutions won't become irrelevant overnight. But the trajectory is clear. American financial power is diminishing, alternatives are maturing, and the world is becoming less dollar-dependent and less reliant on American financial infrastructure. This matters because financial power has been the foundation of American global influence in the post-Cold War era. Military power remains significant but is expensive and politically difficult to use. Diplomatic influence depends partly on economic carrots and sticks. When the economic tools weaken, overall American power weakens. What troubles me most is that this was predictable and in some ways self-inflicted. Weaponizing the dollar system taught everyone that dollar dependence is a vulnerability. Accumulating massive debts reduced fiscal flexibility and increased dependence on foreign financing. Political dysfunction undermined confidence in American economic management. Aggressive unilateral action fractured alliance support for dollar-based systems. Russia didn't break America's financial shield through superior strength. They identified the pressure points where American policy created vulnerabilities, then pushed on those points systematically while offering countries alternatives that reduce their exposure to American financial power. By December 2025, the breaking is well advanced. The question isn't whether America's financial shield is weakening. It clearly is. The question is whether the decline can be managed and stabilized, or whether we're at the beginning of a faster collapse in dollar dominance that fundamentally reshapes global power. Russia triggered the pressure point, but the vulnerability was there because of choices America made, choices about debt, about weaponizing finance, about unilateral action, about taking dollar dominance for granted. Now we're living with consequences we didn't fully anticipate and don't know how to reverse. The financial shield is breaking, and the world that emerges as it breaks will be one where American power is more constrained, more contested, and less able to shape outcomes through economic tools that have been decisive for 3/4 of a century. Russia didn't create that vulnerability, but they're exploiting it brilliantly, and we're running out of time to repair the shield before the breaking becomes irreversible.